Hello everyone. This is part 2 on our series on secondaries. In the first part, I related to you why this is such a hot topic right now in the private capital market. Now we're going to go into the nuts and bolts of secondaries. What are LP secondaries and what are GP-led transactions? So we'll keep it simple and straightforward before we go on to part 3 later on. Let's start off with LP secondaries. On the bottom, you have the private equity fund, which is run by the GP on the left-hand side. And obviously, like any private equity fund, it has a group of existing limited partners, the institutional investors that are investing in the respective fund. Imagine one of those LPs, potentially for portfolio construction reasons, wants to sell out. Imagine this fund is just about in year 4 of its lifespan. So the selling LP will be looking for a buyer. That buyer will step into the shoes of the selling LP. That means all rights and obligations will be transferred between the selling LP to the buying LP. Now, I mentioned the fund is in year 4. So that means that likely, let's call it 60% of the capital committed by the selling LP has already been drawn down and has been invested. So there's a fully funded portion of the portfolio and there's an unfunded portion of the portfolio. That means the remaining 30% of the commitment by the LP that has not been drawn down yet. In our case, in a straightforward LP secondary, the new buyer will take over all the rights, all the obligations. So in future, he will be the one who will respond to capital calls by the GP. That's a LP secondary. Basically reducing the illiquidity, the natural illiquidity that private equity has in its primary funds for the LPs. Now, those transactions can easily be tailored to the taste of the selling LP. So imagine the selling LP would not mind retaining some of the upside in the GP. Let's say that GP has been really performing really well and the selling LP is literally just selling. Why? Because of, we talked about that earlier, the denominator effect, the public equity portfolio has dropped down and so on. He is being asked to reduce its exposure to private capital. So what could we do? In a natural sale of the selling LP to a buying LP, the selling LP would give up all its upside, of course also all its responsibilities. Now, in this case, the structure can be useful if the seller does not wish to sell all its fund interest at a discount. As we saw in part 1, pricing in secondaries on average is usually happening at about around 14% discount to NAV. So this can be an interesting structure to give a selling LP liquidity, offer them a tailored solution by still retaining some of the upside. Now, GP-leds. So far, we've been with LP-leds. Let's jump on to GP-leds, or, and you may have heard this quite a bit in the last 18 months, continuation funds. Here, we're looking at the left side at an existing private equity fund. That private equity fund, imagine, has come to year 9 of its lifetime, year 10 being its last year, and it may still have 1 or 2 assets pending there. Some of the LPs really want to exit, the selling LPs above. So what we are doing now, we're setting up a continuation fund on the right-hand side. That means the continuation fund will acquire the remaining assets from the existing fund. Now, how has the continuation fund raised money? It will have had LPs, new LPs coming in that were not in the existing fund, but it may have some existing LPs that roll over into the continuation fund. Why? Because they still see some upside in those assets that are being transferred between those two funds. So very clearly, both funds have distinct sets of LPs. Nevertheless, some of the LPs, not all of them likely, from the existing fund will also move over to the continuation fund. Remaining assets, the portfolio transfer happens between those two funds, and of course the continuation fund pays the existing fund for the assets that are being transferred. So this can happen, this structure, for a single portfolio company or for multiple portfolio companies, where we basically transition it from an existing fund to a newly set up limited partnership. One important comment here is that both of those funds will be ultimately managed by the same GP. So those portfolio companies very often are prized assets that have upside potential left, or a second phase of value creation is planned that cannot be executed in the existing fund, because the existing fund is coming to the end of its lifetime. So that gives you a little bit of an idea of the different structures you can find in secondaries. Now, part 3 will tackle one or two more strategies for those of you that want to go deeper. Thanks very much for joining. Please subscribe below if you want to be notified about part 3.